You've been taught this story your whole life. Put your money in the market, let it grow, be patient, and one day you'll retire comfortably. It sounds reasonable. It sounds like math. But here is the thing about that story. It was written by the people who need your money flowing in, so theirs can flow out. Every single dollar you move, based on a hot tip, a trending ticker, or a headline that made your pulse jump, that dollar had a destination planned for it, long before you ever opened your trading app. Now, think about it from the other side of the screen. If you knew a stock was about to spike because you controlled the supply, or because you had access to numbers the public wouldn't see, for another 3 weeks, would you share that with strangers? On the internet? Out of kindness? Of course not. You'd buy first, you'd buy quietly, and then you'd need a crowd of everyday people to pile in after you, pushing the price higher so you could sell at the top and walk away clean. That is not a conspiracy theory. That is the actual mechanics of how billions get moved. It starts with a story, some irresistible narrative about a once-in-a-lifetime opportunity. That makes you feel like you'd be a fool to sit it out. That story is the bait. Once enough people bite, the next phase kicks in: control. Sometimes they choke the supply, so it looks scarce, and you panic, buy. Sometimes they flood your feed with only the good news, so you keep doubling down. Either way, you're not making a free decision anymore. You're following a script someone else wrote for you. And when the price hits that sweet spot, that peak where the chart looks like it could climb forever, that is exactly when the people who started this whole thing quietly cash out. Every share they sell, someone like you is buying. By the time the music stops and the price craters, they're already gone. You're the one left refreshing the screen, watching your balance shrink in real time, wondering what went wrong. Here is the brutal answer. You didn't do anything wrong. You just played a game where the rules were written against you from the start. And the scariest part isn't even the illegal version of this. Much of it is perfectly legal, dressed up in financial jargon, protected by loopholes that make it all look legitimate on paper. So before we go any further, sit with that for a second. The confidence you feel when you click buy, where did it actually come from? Was it your own research? Or was it a feeling someone carefully manufactured for you? Because what I'm about to walk you through next is exactly how one man turned that manufactured confidence into millions, while ordinary people lost everything. So let's talk about $28 million. That is the #1 man pocketed from a single trade. Not over years, not from decades of patient investing. One move, one stock, one phone call he wasn't supposed to receive. And while he counted that money, thousands of regular people who bought the same stock at the same time watched their portfolios bleed. The difference between him and them wasn't skill, wasn't research, wasn't timing in any honest sense. It was a leaked phone call and a check disguised as a consulting fee. Picture a stock nobody's heard of. It is trading at almost nothing. A group of insiders quietly scoops up massive amounts of shares through hidden buyers, people the original source literally called rat holes. They pay pennies. Now, their brokers start dialing. They call people like you, like me, telling us this stock is about to take off. And because enough people believe it, they all rush in at the same time, competing for a limited number of shares. Basic supply and demand. The price shoots up. Now, here is where the math gets cruel. The insiders bought at the floor. You bought during the frenzy. The moment they start selling, the price collapses. You're not just losing money, you're funding their exit. Every dollar of their profit is a dollar someone else lost. That is not a metaphor. That is arithmetic. And you might think, okay, that was the 90s. Penny stocks, boiler rooms, whatever. But right now, today, there are Discord servers and Telegram channels doing the exact same thing with different logos. Someone in your comments even mentioned getting ads, promising that €1,000 turns into 10,000 in 3 months. You ever wonder why the person running that ad doesn't just quietly invest their own money instead of paying to tell strangers about it? Because you are the product. Your buy order is their exit liquidity. Now, scale that up to Wall Street. In the 1980s, an investment banker named Martin Siegel sat inside Kidder Peabody, financing mergers. He knew which companies were about to get acquired before anyone else on the planet. When a giant like Nestle decides to buy a company outright, they have to offer shareholders a premium, a price above what the stock is currently worth, just to convince everyone to sell. That announcement alone sends the stock jumping. Siegel knew these deals were coming, so he fed that information to an investor named Ivan Bosky, who loaded up on Carnation shares in the $60 to $70 range. When Nestle's offer hit the news and pushed the price past 80, Bosky walked away with $28 million in profit from one deal. Think about what that means for you. By the time you see the headline, by the time your app sends you the notification, the person with the real information has already bought, already profited, and in some cases, already sold. You're not late to the party. The party was over before you even knew the address. So here is the part that should genuinely unsettle you. When the dust settled in 2008 and millions of families were packing boxes and handing back house keys, not one of them understood the chain of ownership that had been wrapped around their necks from day one. Take someone like John. He walks into a bank, signs a mountain of paperwork for a $100,000 mortgage, and believes he just bought a home. He didn't. What he actually did was generate a product. The moment his signature dried, Countrywide had already cashed out application fees, origination fees, closing costs, all skimmed before John got his first payment coupon. Then, they quietly sold his entire loan to Lehman Brothers for the full $100,000. John's checks still went to Countrywide, who took another cut before forwarding the rest. If John stopped paying, that was Lehman's problem. Now, Countrywide had already moved on to the next signature. Lehman didn't want one mortgage on their books either, so they took John's debt, mixed it with thousands of other loans, some from stable earners, some from people who could barely make rent, and blended it into something called a CDO. Think of it like a smoothie. Toss in fresh fruit, toss in stuff that is going bad, blend it together, and nobody can taste the rot. That is what a collateralized debt obligation was. John thought he was a homeowner. In reality, he was raw material. Countrywide was the factory floor, stamping out loans as fast as possible. Lehman was the packaging plant, wrapping it all up and slapping a label on it. Every single layer above John existed for one purpose: to extract value from the layer below. Now, zoom out. While this assembly line ran at full speed, members of Congress sat in closed-door briefings about policy changes that would move entire sectors. A politician hears billions in clean energy funding is coming, loads up on solar stocks before the announcement hits your phone. And by the time you read the headline, the price has already jumped. They disclose those trades eventually, sure, but the filings show up weeks later. You're reading the receipt for a meal someone else already ate. Strip away the jargon. There are people who own the information, people who own the machinery, and people like you who own the debt, the risk, and the monthly payment. Value flows up. Consequences flow down. At the bottom of every one of these chains, someone is making payments on something engineered to benefit everyone except them. Now you'd think, before any of this got sold to the public, somebody would have checked whether those bundled loans were worth buying. And technically, somebody did. Picture yourself as one of those investors in 2007, sitting at your desk, looking at a CDO rated AAA by 3 separate agencies. You're not stupid. You've done your homework. You read the rating. You checked the returns. Everything on your screen is telling you this is safe. And you click buy. That is the moment that cost people their retirements, their homes, their kids' college funds. Not because they were greedy or dumb, but because they skipped one step that takes about 15 seconds. And that step is painfully boring. It is not some grand strategy. It is not diversify your portfolio, or think long-term, or any of that poster on the wall advice that sounds wise, but means nothing when your finger is hovering over the buy button. It is this: before you buy anything at all, you grab a piece of paper, not your phone, not a notes app, actual paper, and you write down one sentence finishing this question. Who profits if I lose money on this? That is it. Just one single sentence. If the answer is the broker who recommended it, you pause. If the answer is the company that rated it, you pause. If you can't answer it at all, you close the tab. Every single person who bought those CDOs could have asked that question. Who rated these bundles? Moody's, S&P, Fitch. Who paid those agencies to rate them? Lehman Brothers, the same company selling the product, was paying for its safety label. One sentence on a scrap of paper would have made that visible, but nobody wrote it down because the AAA rating felt like enough. The monthly returns felt like proof, and the buy button was right there, glowing, easy. One click away. This works because scams, whether it is a CDO in 2008 or a viral coin in your group chat right now, they all rely on the same thing: speed. They need you to act before you think. That 15 seconds of friction, pen touching paper, your hand slowing down, your brain actually forming the words, that is the circuit breaker. It forces you to confront the one thing every scam is designed to hide, which is who is on the other side of your trade and exactly why they want you in. So here you are. You've seen the playbook, how hype gets manufactured, how insiders position themselves before you even hear the ticker, and how the exit door slams shut once regular people pile in. The question in your gut isn't whether this happens. It is whether you're standing in the middle of one right now. I'm not going to tell you there is a formula that turns this into easy money. That pitch is what got people burned with subprime, mortgages, penny stocks, and every viral coin that hit zero while someone's Lamborghini ad was still running. If wealth were that simple, they'd keep the secret and skip your $99 a month. When something spikes and you can't explain why in one sentence, step back. Let the crowd rush in while you watch from the sidewalk. Your real edge is the right to do nothing. Close the app. Sit on your hands. That is not weakness. It is the one move insiders can't front run. Buffett put it simply: learn from your mistakes. But better yet, learn from other people's. You just spent the last few minutes doing exactly that. So tell me, was there a moment you almost bought into something? That felt just a little too perfect. A tip, a launch, an ad promising 10x returns. What stopped you? Or what didn't? Drop it below.